Markets at all-time highs, infighting in Congress, and the holiday season and year-end approaching. What does all this mean to the economy and to the markets? Stick around as I discuss the economic update here at Barber Financial Group. Hello everybody, I'm Dean Barber, founder and CEO of Barber Financial Group. Welcome to the monthly economic update. We are recording here on the 3rd of November, and October was, by all accounts, a great month for the markets. Economically, things look very sound. We do seem to be in what I will call a slowing growth period, but that slowing growth period I think will continue over the next 2 years through the end of 2023. Avoiding any type of recession. Caveat to that would be a massive tax bill that would cripple the consumer. And of course, there's been a lot of talk about that. We really have no idea exactly where that's all going to land. But let's just take a quick look at what's going on with the equities markets. And so this first screen that I've got you on here is basically showing everything from the OEF, which is the S&P 100, all the way down to the SLY, which is the small cap 600. And one of the things I want to point out to you, I've not really done this in any of our updates before, but when we look for an example at QQQ, it's showing that indice as very bullish. It shows that 33 of the companies out of that QQQ, the NASDAQ 100, are green, which is very bullish. 54 of those companies are neutral and 13 are trending negative. So you can look kind of down the line here and you can see that every indice is either neutral or bullish and a couple that are very bullish. We look at this kind of information on a daily basis to see where's money flowing? What do the stocks underlying these indexes look like? So I wanted to take a moment to give you a little bit deeper dive on what that looks like. Let's go ahead and create a chart here of these different indices. And I want to start out on a year-to-date chart with you. And so year-to-date, you can see if we sort this by best performing to worst performing, your Dow Jones Industrial Average happens to be your worst performing sector of the market on a year-to-date basis, but that worst performing indice is up by 17.91%. Our best performer is the S&P 600 small cap, up almost 26%. You get the RSP equal weight, S&P 100, and S&P mid cap, as well as the NASDAQ, all up 24% plus for the year. If we take a look at the last month, we see a little bit more divergence in the last month. Our best performing asset, NASDAQ, up 8% in the month. Small cap is the lagger for the last month, up just 3.82%. And then, of course, you got everything else in between. So what does that lead us to? And we've been talking about the fact that the markets are overvalued. I still believe that the markets are overvalued, but I also believe that some of the absolutely blowout earnings that we've seen here over the course of the last few weeks, if those earnings can continue to remain strong through corporate America, these equity prices can be sustained and we can still have some upside potential from here. I don't think by any stretch we can go through another 10-month period with, anywhere from 18 to 25% returns. I don't think that's in the cards at all. But I do also not think that a bear market is imminent. And because of what I said at the very beginning of this economic update, that I see a slowing growth pattern, but still a growth pattern over the next 2 years, I think that keeps us out of any kind of recession, and I think it keeps us away from a bear market. Now, that doesn't mean that we can't have the normal, 10+% corrections here and there, which are healthy for the markets to blow off a little bit of steam. But I think we're going to finish out this year in a strong fashion, possibly another 2 to 3% more in total return between now and the end of the year. And I also think that interest rates on what our benchmark is, the 10-year Treasury, will remain fairly subdued, hovering in that 1.5 to maybe 1.7% range. That should start to leak up next year, but I still think we finish 2022 with a 10-year Treasury at around 2%. And I think our economic growth will slow. And we'll see total GDP growing at a 2 to 2.5% total annual rate through 2022 and 2023. All that remains to be seen. And again, the big caveat that's out there right now is the tax proposals that are out there. Those could change everything overnight, but doesn't seem to be anything in sight as far as any kind of conclusion on what that's going to be. So stay tuned. We'll continue to monitor all of this and more. And I want to take this opportunity to wish everybody a very happy Thanksgiving season. I hope you get an opportunity to spend time with your family and with your friends and do the things that you truly love and enjoy. I'll be back with you very early December for another economic update. Thanks for joining me. Thanks for watching me here on YouTube. I want you to make sure to subscribe to our YouTube channel, give us a thumbs up, share this video with your friends. And if you have comments or questions, you can leave those in the comments section.